Hello again, traders. Dwayne Chopper there from DRFX, Forex and Trading. Now, this video is going to show you two main reasons why trading on a smaller time frames leads to continued trading losses in both the short term and over the long term for retail traders. Several days ago, I made a projection on the New Zealand Japanese yen that we would see the start of a sharp reversal. And the two main technical factors that supported that projection are the two main reasons why trading on a smaller time frames generally leads to long-term losses, and why trading on larger time frames generally leads to stable and larger profitability over the long term. Now here you can see the snapshot of the daily chart of the New Zealand Japanese yen several days ago, where I'd made a projection that the market was going to initially head back inside of this consolidation setup before starting a major reversal in favor of the Japanese yen. And as you can see from the live picture of what is now taking place, this is exactly what has happened. The market pulled back and took us back inside of the consolidation before continuing the bearish momentum and creating these sharp bearish movements in favor of the Japanese yen. Now, there are two main technical factors that supported this forecast, and are the two main reasons why trading on the larger time frames presents so many benefits in terms of profitability, because of your ability to see where the market is going to start these major reversals that will allow you to take advantage of them with strong trading opportunities. Now, the first major technical reason had to do with the fact that the market had recently hit this major price point at 83.80, and usually whenever the market returns to these major price points, if there's a consolidation setup and a breakout taking place nearby, the market will usually respond by hitting this price point and reversing and heading back inside of the consolidation. So even though the market had provided a strong bullish candle that indicated that we would be continuing the uptrend by starting a sharp breakout from this consolidation setup, the fact that we had returned to this major price point on the daily chart made this breakout highly unlikely, and that the more likely scenario was that the market was going to head back inside of this consolidation. So essentially we were projecting a false breakout reversal that would take us back to the support point. Now, of course, when you're trading on the smaller time frames, in most cases we would not be aware of the presence of this major price point, and we would be continuously opening up long positions, given the fact that the market had already broken out above this resistance point, and we would be setting our price targets and our trading profit targets at a much higher level. So of course, naturally, this reversal that has taken place would have taken many by surprise and would have led to sharp trading losses. Now, the second reason why I expected the market to reverse and why trading on the larger time frames is much more beneficial to traders is the fact that there are certain types of waves that lead to the formation of consolidation setups across the currency market. Usually whenever you have these types of sharp bullish and bearish waves, it usually indicates that the market is going to eventually form a consolidation setup. Now, once we see these patterns appearing on the larger time frames, what it means is that the reversals that take place as the market forms this consolidation setup are going to be much larger and much sharper. So looking at this wider view of the daily chart of this currency pair, you can see that the market had created these same types of sharp bearish and bullish waves, and this is why I made a projection that the market was going to be forming this consolidation setup over the next several weeks and months based on the nature of these bullish and bearish waves. So the second reason why I projected the market to reverse had to do with the fact that it was expected to reverse at this area here as part of the formation of this third bearish wave. Again, if we're focusing on the smaller time frames, we would not have been aware of these patterns here because of our focus on the short term and that the farthest back we would probably focus our analysis on would probably just be at the start of this uptrend. Most traders on a smaller time frames would not narrow the charts like this, and of course, and therefore would not be aware of these patterns that lead to the formation of consolidation and that lead to these sharp reversals. So these are the two main reasons why trading on the smaller time frames can present so many disadvantages and can lead to so many unexpected and sharp reversals that oftentimes traders blame on crooked brokers and other reasons that have nothing to do with the nature of the market itself. So once we are aware of these patterns and once we focus on the larger time frames, you're in a much better position to take advantage of them, to be aware of them, and to continually take advantage of them for short-term and long-term trading benefits. So move up from the smaller time frames and focus solely on the larger time frames, where the market offers much greater profitability over the short term as well as over the long term.